Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Monday morning, new week. And can we hope for some optimism? Because that is sorely needed. The way the market left off last week, it's been devastating for portfolios, small caps, mid caps, crunching falls. So that's the hope and the wish. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. As always with me, my colleague Surabhi and Nigel. Guys, hi, good morning.
Hi, morning, folks, and happy Monday to all of you. Hope and faith is what we're really holding on to, Prashant rightly said. And I think there is some leftover Valentine's love. I think Nigel's still feeling the pink and the blushes. So it's good, but I think the bulls will really hope that maybe we've started that process at least of a bottom formation. It doesn't get worse from here.
Well, that's right. On markets, I think the bulls would be breathing a sigh of relief because at least they got 2 days when the markets were shut. Last week was that sort of a week.
Yeah.
And, otherwise, I just hope everyone in Delhi is safe because, that earthquake that took place earlier today, prayers to everyone out there and strength, and hopefully it's not too bad as per what the reports are suggesting.
No, absolutely unfortunate headlines out of Delhi over the weekend as well.
Indeed.
Also with the unfortunate incident at the railway station. But just hope everyone's okay.
All right, well, those are some early morning visuals coming in. 4 on the Richter scale. People, of course, waking up to this morning.
As of now, I don't think there are any reports of any significant damage or any other calamity. So we just hope that it stays that way.
Absolutely. All right, well, I'll just quickly take it from the top in terms of what you need to know as far as markets are concerned. So last week, of course, saw a crunching fall, as I was saying earlier, in the broader markets. You could have seen how many ever corrections, but when you're living through one, it does always feel like the worst. And this definitely is, I think it ranks right up there in terms of the pain that it is causing really out there. Now, this is a graphic I want to spend like a minute and a half on. So the last week changes up on your screen, 7.5% down on the mid-cap index, 19% down on the small cap index. The year to date, the returns are 9.6% for the mid cap index down and 22% down for the small cap index. Actually, the mid cap index is 19%, 19% and 22%. The last one is what I want to spend the time on. Let's just put the graphic back on. The 10-year CAGR return is 14 and 11%. The point I'm trying to make is the falls in the very near term, of course, have been very large and very sharp. But what this also means is that the 10-year CAGR return for the small and the mid-cap has now reduced to somewhere close to what essentially is the cost of equity. About 11, 12, 13, 14%. Depends on how you calculate it. But, the excess returns, at one point we were running at about 20% plus CAGR. Over a 10-year basis, which was absolutely unnatural. I mean, the long-term return, 25-year return for, the Nifty, for example, is about 12%, 13%. Now, on a 10-year CAGR basis, I looked at returns 3 or 5 years as well, but just sort of went back and looked at all the way from 2015. That is, the excess froth has come off, and now we are more reasonable on a normalized kind of level, 14 and 11% respectively. So that's essentially what I basically wanted to start with. Now, having said this, it's obviously impossible to look at this and say, well, this is it. I mean, a bottom is here because, excess froth is out of the system. It's impossible to call a bottom. But I think I'd also like to emphasize that there is no real macro risk in India. I mean, if that is essentially what you're wondering, and sometimes price action creates its own narrative. You see prices not recovering, it continues to fall, and we start to wonder, well, is something really wrong? Is something going to come out and the market is responding to that? I mean, there is no real macro risk. It's just sort of getting more selling at this point in time. Now, FIIs have sold some $21 billion since last October, and they continue to be sellers. But the pace of FII selling has stabilized a little bit. I looked at positioning. Asia funds are now underweight India. Most of our money, foreign money in India, comes from EM funds. Asia funds within that are now underweight. EM funds are relatively and modestly over. They're still modestly overweight, but I mean the excess positioning is all kind of gone. Now contrast what's happening in India with global picture. We are in I think, a clear bull market for global equities. Even as we are suffering this sort of, pain and, big carnage, globally, not just the US, globally things are looking pretty good. The YTD returns will come up. China, 14.5%. YTD. And this is, by the way, the benchmark indices. For China, I looked at the Hang Seng Index, 14.5. Europe is up 13%. US is up 4%. India is down 3%. When I say India, it's the Nifty. So, that's the picture. Countries like Europe, regions like Europe, if you look at the largest 50 companies in Europe, the Euro Stoxx 50, it's now in 2025 finally taking out the all-time high from early 2000. So 25 years that index has not taken out the level. It's doing that now at a time where we are, of course, under a fair bit of pressure. Again, the point is essentially just to point out that globally there isn't very much of a problem. Things are looking pretty good. Now, dollar index is under 107 levels. Early February, we were about 110 levels. You can argue and say that that's largely because, euro has picked up and other cross currencies have picked up. But whatever said and done, your dollar index is well behaved as well. So that's the backdrop. Again, I want to emphasize there's no real science or technique to call a bottom per se, but you can just broadly kind of, look at some of these indicators and say that we've kind of paid the price and we are now running on a normalized kind of trajectory, even though stock-specific things may be different. We'll talk more about that. US markets tonight, just to mention the here and now, US markets tonight are closed, both stocks and bond markets. They'll only open on Tuesday. I'll just put out these levels. Nifty support zone is between 22,620 and 22,775. We kind of hit the lows of January 27th on Friday and then recovered a little bit. Nifty Bank downside level, immediate level to watch out is 48,719. And if you believe that maybe the Nifty Bank is in the process of bottoming out, the 40-hourly exponential will come into play, which is 49,885. That's the level on the immediate level on the upside to wait and watch out for. GIFT Nifty, I don't think is indicating a bit of a start either way. It's down about 20-odd points to begin this Monday morning. Surabhi.
Yeah, absolutely. Lots to track. I just want to actually start with specific news that impacted Wall Street. At least some set of stocks and stocks that people are really interested in. I'm talking about the semiconductor guys because over the weekend we had a Wall Street Journal report come out and say that maybe there could be, not one but two deals brewing and Intel could be broken up. And the chatter is that it could be TSMC looking at one part of Intel and Broadcom looking at the other part of Intel. Broadcom looking at chip designing and marketing and perhaps TSMC looking at the manufacturing operations. I was looking at the TSMC listed stock in Taiwan this morning. It's up about 1.5%. Anyway, the Nasdaq outperformed, the other two indices, the Dow as well as the S&P 500. Things are more or less intact. The retail sales data in the US was not very, very promising. The retail sales numbers for December were a lot weaker than anticipated. But then again, the industrial production numbers were good. So data has been mixed and largely things are chugging along over there. Coming to Asia this morning, Asia is a slightly mixed picture. If you pull up some of the indices, the Hang Seng started really negative. Now it's pulled up in positive territory. Taiwan's actually doing really well, 1% up on Taiwan itself. And the Japanese market is very, very flat. Though, again, it started negative. It's been very volatile and very choppy across Asian markets so far this morning. There's data coming out of Japan, and it's such strong data. The Japanese GDP print is... it's really blown past expectations, 2.8% in the fourth quarter. The estimates were about 1%. The previous number is 1.7%. And even the previous number, Q3, has been revised higher. So it tells us about the strength of the Japanese economy. One theory is that a lot of exports were front-loaded ahead of the tariffs coming through. So that could have aided the performance in Japan in Q4. But really, really strong numbers. And that actually has led to some strength on the yen as well. Versus the dollar, the yen has appreciated almost 0.3%, 0.3.5 the last I checked. Look at that, even more now. Almost a 0.5% move on the yen on the back of such rock-steady, solid numbers coming out of Japan this morning. To talk about the rest of it, the Nifty now has taken support around this 22,800 mark for 3 times. So people are talking about a triple bottom. Is it finally in place? Is it going to be durable or not? The fund flow picture isn't sort of giving us any further reasons to cheer. Again, FIIs were net sellers on Friday, sold off stock in the cash market worth about 4,300 crores. Domestic institutions offset it by exactly the same number. So it was absolutely net neutral, the institutional flows. But just to put things in context, I thought I'd look at some of the other markets around us as well. Last couple of weeks, what has happened? We have been underperforming, we know that, but by how much is the question? So the Nifty is down 1.2% in the last 1 month. The immediate competition is our neighborhood, which is Hong Kong. Look at the Hong Kong markets, and this is at a time when there's so much of tariff talk. But the Hang Seng has surged almost 15%. But it's not just the Hong Kong market or the Chinese market. Other markets in Europe have done really well as well. The CAC and the DAX are up between 6% to 7.5%. So there's some money that's been shifting to Europe. Let's not lose sight of that. Even the FTSE has outperformed us, actually, if you're looking at the last 1 month. And then, of course, there is the US, which anyway continues to chug along, like I said. The NASDAQ is up almost 5%. And even the broader index, the S&P 500, is up 3%. So that explains the fact that it's not just, you can't just put the blame on strong US, but other markets are also picking in the money. That's the short point. I just want to end by talking about earnings because the season is finally over. And Nimesh has been making this point as well. Maybe it's not as bad as feared, but the numbers are still weak. And these are Motilal Oswal estimates that I put up, estimates and final calculations. 5% on Nifty if you put in commodities and metals. If you strip out commodities and metals, then 7%. That's the earnings growth. It's the slowest in the last many, many quarters. Third consecutive quarter of just single-digit Nifty earnings growth. So those headlines don't look good. And Motilal says the downgrade to upgrade ratio, the downgrade ratio is at the steepest since the first quarter of FY21. And so what is the projection for FY26? The question is, does it get better from here on? Motilal still feels that the overall estimates for FY26 are still elevated at around 15 times earnings growth. So let's see. That's going to be the biggest question, I guess, Nigel, whether earnings can pick up from here on, because we can't control flows.
Yeah.
But if the earnings numbers start looking better, then perhaps we know that there's a bottom in place.
Well, that's right. And Pankaj Tibrewal had made this point that the last earnings season is not as bad as thought. And the Nifty 500 companies, just to wind up, I was looking at a follow-up note. The Nifty 500 companies' earnings growth is 8%, which is better than Q1 as well as Q2.
Yeah.
So that's a bit of a positive. Well, the bulls will be hoping that, this 8-session losing streak comes to an end. But hope's not a data point, right? So let's get you a data point then that I'm looking at. Well, the last time around that we saw 8 straight sessions that the Nifty was down, the following week actually was fairly positive, 3 out of the 4 times. So this time around, what's it going to be? That's a data point that's coming in from Samco, so just thought we'll highlight that. Next up, the markets, yes, they're jittery, but actually fundamentals have relatively, improved. Why do I say that? The RBI has addressed the liquidity issue. Remember, there was a deficit of close to 3 lakh crore in the banking system, which has partly got addressed with the cut, with the OMOs, as well as the swaps that we have seen. The budget is focused on consumption. The benefit of that will be seen in the second half of the year. And also, crude oil prices are lower. There's hope that, that Russia and Ukraine war comes to an end, which will be good for us. The yields are lower in the United States, as well as you have the dollar index that's softened from around 109 odd all the way to around 106.7. So that as well is good news. All those 3 indicators positive. On a valuations parameter as well, I was looking at the Motilal Oswal note, and they're saying on a 12-month forward PE, we are trading relatively more attractive on the Nifty in comparison to the long-term averages. So valuations as well, fairly okay. The FIs, well, they've added shorts yet again. The short positioning is at around 84%. Even in absolute terms, it's the highest that we've seen actually, close to around 1.9 lakh contracts on the short side. Now, the important trigger to track is the PCR. Whenever it moves to 0.65, 0.67, we have seen a bit of a bounce. Currently, it is at around 0.7. And the 2 goalposts should come up for you on the screen. The 23,000 call, well, that is fairly active. The 22,800 put. So looking at the options data, looking at the recent levels that we've seen, we should get this 22,750 to around 22,800 mark up for you on the screen. And it's very, very important because you have gone to that vicinity thrice just in the last 1 month or so, and we have bounced up there. So you don't want this support level to get broken out. If you're looking at resistance, which no one's really talking about because mood is so somber, but otherwise the 20 DMA on the Nifty, the 20 DMA on the Nifty Bank, both those 2 are reference points. Stocks that I'm tracking, since the dollar index is weaker, we have Hindalco that came out with a fairly good set of numbers. So the markets, ignored it actually. The stock did a relative outperformance, but valuations in favor as well. So I'll keep an eye out on Hindalco and Vedanta. The creditors meet with regard to the demergers this week. So I'll keep an eye out on that as well. So that's one clutch of stocks. The other factor that I'll be looking at is the finance ministers in Mumbai today. So any kind of sound bites, any kind of commentary is something that I'll be looking at. So the mood is a little bit somber, but keep an eye out on the fundamentals. Actually, they've relatively improved. The hope is this 22,750 mark can hold out.
All right. Well, I think that press conference and the finance minister taking questions should be interesting. And I think a lot of the questions will be with regards to the market because the condition of the market. And we'll get that for you live. Well, William Lee is Chief Economist and Executive Director at the Milken Institute. William, good to have you with us here. Thank you very much for your time. So just 2 things, actually, just questions off the news flow. One is this, there was some expectation that a Russia-Ukraine deal would be arrived at this weekend. That's not happened. And second is, of course, the tariffs, which have been delayed but not forgotten. So they come into effect from the 2nd of April. Again, I mean, some are reading that to say, well, it kind of throws a lifeline, and that's essentially a negotiating tactic. But as someone from JP Morgan on Friday or Thursday was pointing out to us, the scope of what they are trying to do here is much wider. So, they're not lacking in ambition. So it would be wrong and unwise to say that, they don't want to actually do it and take tariffs up meaningfully. So your thoughts?
I think it's very important to remember that President Trump and this administration has a very different use of tariffs than he did last time. Right now, he is really focusing on a very wide-ranging agenda where he's got domestic economic policy goals as well as foreign policy goals in mind. And the use of a tariff, he's discovered, is a very powerful tool. Not only does it allow the United States to shift spending and shift the relative prices of certain key industries like steel and aluminum so that he can try to increase the production of steel and aluminum in the United States. But he's also discovering that the use of tariffs can bring our allies to the bargaining table and get serious about immigration policies, the shutting down the border and shutting off the illicit flow of illicit drugs, the rush of immigration that has invaded our country, illegal immigration, and also looking abroad for the rest of the world. Tariffs are also becoming a very important part of his negotiating tactic to try to get people to say, live up to your promises. To Europe, he said, you promised to have expenditures, military expenditures increased to defend yourselves and not just rely on the United States. So far, you haven't done anything. You have instead kept us out of the European market with a lot of different tariffs and trade quotas and other restrictions, tax policies, regulatory policies. So let's get down and be serious. And that's what I think the use of tariffs is doing to achieve both economic goals of trying to maximize the amount of domestic employment in high-paying industries and increase the production capacity of strategic industries, but around the world to get people to live up to their end of the bargain and to come to the bargaining table seriously.
William, hi. Great to have you on the show this morning. Just your thoughts on, the intrinsic strength that we're seeing in some of the large Asian economies. When Japan's numbers, again this morning, Q4 numbers looking very, very strong on the GDP. And also China. Is something improving? The reason I ask is that if intrinsically these economies are strong, Japan is, we know, but this is more a question on China, then maybe these economies can withstand any kind of tariff heat, and therefore they will seek or they will find better interest from investors compared to markets like India. So your sense on what's happening in China now?
I think the global reaction, and especially the reaction in China, is that while they recognize it's still very important to stay in the U.S. market because the U.S. market is really the largest market for their exports and probably the most profitable market, they think that it's also important to diversify their sources of demand and improve their domestic economy so that domestic consumption can carry some of the weight of improving growth. As you all know, China's domestic demand is in the doldrums right now, and we've had stimulus package after stimulus package discussed. We've seen the central bank ease interest rates, and yet the domestic economy is not there. And as a U.S. trained economist and as someone who's studied, anyone who's studied U.S. history should realize that we in the 1930s tried that supply side approach that President Xi is trying right now. The strategy of improving wages, improving production, making certain industries more efficient. It's really great to increase the paycheck of workers, but if the workers are saving that paycheck because they're concerned that their children are not getting jobs after graduating college, their wealth in the housing market, which is 70% of the household balance sheet, has gone down the toilet and shows no sign of reviving. If the main breadwinner, even the civil service breadwinner, is finding his salaries reduced, or laid off if you're over 35 because you're considered too old and too expensive. In those sort of situations, supply side economics doesn't work. Say's law that supply creates its own demand does not work. John Maynard Keynes in 1930 said you have to increase aggregate demand to get the economy out of doldrums. And China has not been willing to do that because President Xi doesn't believe that any kind of transfer of households is good because it promotes laziness.
All right, very quickly, William, before we let you go, the dollar index has cooled off from an India market perspective. We are quite happy about that. Do you think it's just temporary in nature? Because when President Trump took office, a few years ago, at that point of time as well, we saw the dollar peaking out, and from there it did correct. So do you think this happens again? Or do you think it's just taking a bit of a breather and then it'll strengthen from here on?
That's a great question. You need to understand why it is that the dollar is strengthening. Because with Donald Trump coming into office, global investors are seeing the U.S. as not only a good place to invest, but also a safe place to invest. So the U.S. has been the source of innovation in artificial intelligence and other high-tech industries. And if you look around the world for investment opportunities, notwithstanding what you just said earlier about how European markets and Asian markets are starting to do better, for the longest time, the longest consistent winning record has been investing in the United States. And that has been the source of dollar strength, and I suspect that'll continue.
All right, William, it's a good conversation, as always. Thank you very much for joining us here. We'll take a quick commercial break here, but we've got lots of stock-specific action to track. We'll get to that in just a bit. We're looking at stocks like Mahindra & Mahindra, GSK Pharma, Narayana Health, Zentech, and BHEL, which are on the radar of positive news flow. Glenmark, United Spirits, RVNL, Aditya Birla, Fashion, and Borosil Renewables are on the red side of that screen. Stay tuned, coming up.
Okay, so it seems the Asian markets have finally made up their mind and the color is green. A lot of the initial opening volatility has now given way to broad gains, and particularly in these two markets, the Hong Kong market as well as Taiwan. They're the strongest in the region, but Japan's also okay, and Singapore is up about 0.3% as well. So looking good. The implied open is suggesting that we could still start 20-odd points lower. Let's see, some caution there, given the extent of the fall last week. Let's talk about individual stocks as well, which are the ones that you have to keep your eye on. Earnings season is now behind us. We only have some tail-enders, but our team is standing by with the CNBC-TV18 list of top stocks to watch. Hi, guys. Good morning and a happy Monday to all of you. So, Darshan, you go first. M&M came out with some of the details of the bookings they've made for their new high-profile electric vehicles, is it?
Morning, Surabhi. So, M&M has announced, basically disclosed the initial booking update of its recently launched two electric vehicles, that is XEV9E and BE6, and booking is looking good on first day of the launch, that was on February 14. Company is saying that it has received bookings of around 30,500 units and booking value is around rupees 8,500 crore. Good part is that XEV9E forms 56% of bookings and BE6 forms 46%, and Top and Pack 3 accounts for nearly 73% of total bookings, and deliveries are expected in March. But now what we'll have to see is what is the cancellation rate, because if you look at this total booking, that is 30,500 units, it amounts to, basically translates to order book of nearly 6 months, because M&M after Q3 con call has announced that initial target for these two electric vehicles is 5,000 units per month. So the focus would be on cancellation rate, but on the back of very good booking on the first day of the launch, I'm going with green for M&M.
Okay, all right. So thank you very much for that. So Mahindra & Mahindra in focus this morning. Let's talk about Glenmark Pharma and GSK as well. Vinny is here with details. Vinny, good morning.
Good morning. So both these are in focus today on the back of their earnings. Now, Glenmark Pharma missed the street estimate is what we're seeing. Now, red is what we're expecting. Net profit of the company, surely they came into a profit this time versus a loss, but there was an inventory adjustment then when you look at it. And that is why revenues are also looking like a very strong growth and a sharp growth that has come in. But do not forget that adjustment that is there is what we're watching out for, because on a 2-year basis, revenue growth, when you look at it, it's approximately just 1-2%, quite a flattish growth that we're seeing. R&D spends, they have seen a very sharp decline because innovation was something that was lower. So that is not that much of a positive when you see a 27% decline in terms of R&D spends for a pharma company. Margins 17% versus the expectation and the guidance that they're given is 19%. So it's still lower than the guidance, though the management had spoken about recovering in the second half of the year. So sequentially improvement in terms of margins, but still missing the guidance is what we're watching out for. And lastly, price erosion has led to a muted performance in the US business, and that is why Glenmark Pharma Pharma, we're expecting red. GSK Pharma, on the other hand, a strong set of numbers, 35% growth in terms of profits, revenue growth of around 18%, margin seeing an expansion of around 300 basis points, good traction across all their segments, cost efficiencies supporting margins, general medicine volumes have seen a growth of 11%, and management is expecting to sustain these levels of margins going forward. They have some launches also planned in FY26. That would be a positive given that they are oncology launches. So that is what we're watching out for, and green expected today.
Okay, all right. Thanks a lot for that, Vinny. So from Dawa, let's go to Daru. Mangalam is here to tell us about United Spirits. Mangalam, tell us what is your analysis. I'll tell you about the testing. Go ahead.
I'll tell you about the analysis, Nigel. So if you like American bourbon, the likes of Jack Daniels, etc., they might come at a slightly more favorable price to India right now, and that's because of the announcement that came over the weekend. India has actually lowered tariffs on imported American bourbon from 150% to 50% itself. Remember, this is one part of the overall taxation on imported alcohol in India. The tariff, the other parts are, the central and state duties, which haven't been changed. So this is one part which has been slashed from 150% to about 50% itself. And reports suggest that India has imported bourbon whiskey worth nearly $2.5 million in 2023-2024 itself. And a large part of that, nearly a fourth of that, came in from the US. From a listed company standpoint, who does this impact? Maybe some increased competition for players like United Spirits, but the overall prevalence of bourbon in United Spirits portfolio is not as much. They do have the American Pride, which is a blended whiskey brand made from bourbon and Indian neutral grain spirit. So that is one of their products which it directly competes with. See some mild red on account of that. But the good part, the larger good, is that if there are favorable policies coming in from the government on account of import of alcohol, maybe some of these companies go ahead and import products of their own for the Indian consumer. We'll keep an eye out on it.
Okay, so bourbon whiskey all set to get cheaper. Not sure about the consumption. I'm sure Nigel can tell us a thing or two about that.
Very small, right, here in India.
I'm not too
bourbon.
sure, not a whiskey drinker, but I don't think it's that big here, right?
I mean, as a percentage, the total imports, I think, of bourbon into India is less than 25 crores in the previous year.
Okay.
So that's how small it is. That's a normal retail shop in Delhi.
Okay, fine. So not much of a threat, I think, not much of a competition or disruptor.
But you have an option now, and we'll have to see what kind of impact it can have.
We will see. We will see if habits change. And let's get back to some other stocks that are in focus this Monday morning as well. Back to Vinny for that. Vinny, what else is on your list?
So a few more earnings that we're watching out for. RVNL, firstly, expecting red here. Net profits are down by 13%. Revenues, very, very muted performance this time. Margins also have remained flat. So not an exciting set of numbers. Operationally, seems like a muted set coming in. Execution is something that we should be keeping an eye out on in terms of commentary from the management. ABFRL, also we're expecting red here. The company's net losses have surely reduced a bit. 51 crores versus 77.9 crores last year. But overall, it's missing the street estimates. Revenues are just a 3% growth. Lifestyle business of theirs is quite flattish on a year-on-year basis. Pantaloon business has not done anything great. Mainly the growth was impacted because festive season had moved from moved on from Q2 and came into Q2 versus Q3. So yes, that is something that is impacting. Margins were supported by cost efficiency. So margins seeing an improvement on that front, 14.8% versus 13.3%. Lastly, Narayana Health is what we're expecting, a green coming in. Good growth that came in as a surprise growth was from the Cayman unit of the company. And that is what is something that the street was watching out for, that when would he start seeing a recovery or, moving towards the positive return front. So faster ramp up there. International patients from especially coming in from Bangladesh still remain a concern because international revenue has halved versus last year and last quarter. Now revenues 13% growth overall, margin seeing an a bit of a muted performance. Keep an eye on Narayana Health. Green is what we're expecting here.
Okay, all right, Vinny, thanks very much. In fact, we'll be chatting with the management of Narayana Health in a little while from now at 9:40 a.m. We'll have Sandhya J, the company's CFO, joining in. But with that, let's quickly move on. We had numbers come out from Borosil Renewables as well. Vivek, morning. How do they look?
Well, good morning. Largely along expected lines, Q3 was a very muted quarter for the company. Export markets saw significant demand erosion, and in the domestic market, while there was demand, volumes up almost 14%. Like the company has been alluding to, there has been significant realization decline as far as the sales prices are concerned. So revenues, although they were higher by close to 9.5%, the company actually saw an operational loss of a little over 10 crore rupees versus an EBITDA last time of over 20 crore rupees. On the back of that, there was a loss on the bottom line as well. close to 30 crore rupees loss that the company saw this time around versus a loss of 15.5 crore last time around. On the back of the fact that there has been dumping, domestic prices have fallen significantly, and this is what has led to the problem. However, we expect the stock to open in the red, but do not be surprised if we see a recovery, because there are two important developments that has happened in the last 2 weeks as far as Borosil Renewables is concerned. Number one, there has been a final application of the anti-dumping duties on imports of textured, tempered, coated and uncoated glass. This is from China as well as Vietnam, and this is for a period of 5 years. And also the Commerce Ministry has recommended the imposition of definitive countervailing duty on solar glass imports from Vietnam. Both of this is expected to support the domestic industry, where Borosil Renewables is the largest player.
All right. Thank you very much, Vivek, for that. So that's an interesting one, as always, to track. Now, Zentech and BHEL are the next ones we want to focus on. Upasana is here with details on both. Upasana, morning.
Good morning. First up, let me start with Zentech. Company overall reported a steady set of numbers. Revenue increased by 53% on a one-year basis, while company says that it is on track to meet its FY25 revenue guidance of 900 crore. And coming to PAT saw a growth of about 42% on a one-year basis, which was mainly aided by sharp rise of 4.2 times in the other income. EBITDA margins were under pressure, down about 1,370 basis points at 29%. This is mainly because of the sharp rise, that is nearly about 4.8 times rise in company's finance cost, impacting the overall margins. Company is confident of achieving its EBITDA margin guidance of 35% and PAT margin guidance of 25% is what the company has indicated. Now, company's order book position also stands strong at 817 crore as of 31st December. Now, company has also announced integration of Vector Techniques and Bhairav Robotics into its portfolio, and it says that these acquisitions will further enhance company's expertise in UAV propulsion, autonomous robotics, and even advanced aerospace components. Company has also acquired Applied Research International, which will also bolster company's defense simulation capabilities. Now, coming to BHEL, the stock will be in focus today on back of the order win. The company gets LOI for a project worth 6,700 crores from Signeri Colliers company. Hence, even this stock will remain in focus, and I expect both these stocks to open in green today.
Okay, all right. Got it. Thanks very much for that. Upasana, let's quickly recap the list of stocks to watch today. The ones that have positive news flow around them are M&M, GSK Pharma, Narayana Health, Zen Technologies, and BHEL. The ones that perhaps may start a little soft could be Glenmark Pharma, United Spirits, RVNL, Aditya Birla Fashion, and Borosil Renewables. All right, let's now move on and figure out how the week has started for the commodity markets. We have Manisha joining in with the latest. Manisha, good morning and happy Monday to you. What's happening?
Thank you for that, Surbi. Well, we've started commodities open slightly on a lower side. Well, all-time high was 29.40 last. We are trading around or below 2,900 right now. So there is some profit taking after that very strong run-up that we saw in the gold prices. Having said that, tariffs, inflation concerns, and a lot of physical buying for gold clearly has been supportive. Silver also trading very close to its 3-month highs. We did see prices gain up for a 6th straight week in the previous one as well. The crude oil prices, after hitting $77 a barrel, are trading at a 74 right now. The markets are watching out those statements of a peace possibility between Russia and Ukraine, and that has taken some premium off the prices. And when you look at the metal prices, well, we have seen a very slight marginal profit taking here as well. So even as copper prices are holding around those 3-month highs, but they're off the lows that we saw in the previous week, the markets will watch out for more economic data in this week and, of course, statements to take further cues.
Yeah, it's an important one, Manisha. Yeah, thanks for reminding us. Those supposed peace talks, I think officials from both sides meeting in Saudi Arabia, I think, to sort out the Russia-Ukraine issue. And maybe, hopefully, because of that, we won't have any more tariff headlines, at least for the next couple of days. Thank you for that. Well, let's take a very quick break on that note. We'll come back on the other side and connect with Prakash Diwan. We'll discuss some fundamental stock ideas.
Welcome back. Well, we have listed on all the top stocks that you should be tracking. Prakash Sivan joins us to help us out with some fundamental analysis. Good morning, Prakash. Hope you had a good weekend. Well, let's talk about a couple of stocks then. Mahindra & Mahindra. First day, first show, 31,000 bookings, estimated at more than 8,000 crores. Wow, what a response to their EV launch. What's your view on the stock? The management was sounding very optimistic about prospects in the tractors business, and this gives it additional fillip. Your take.
Good morning, Nigel. Thank you for having me on the show. So I think, a lot could probably do with, the fact that the bookings opened on 14th February. And we just hope that not too many of them are promises made on Valentine's Day to be buying a new electric car. But on a more serious note, I think 30,000 plus is a very good number. It's just now that, the rollout will probably get very, very critical. The ability to manage expectations in terms of the waiting period is something which they'll have to do something about. And my sense is they possibly could ramp up. While they did mention 5,000 cars a month, they could probably push themselves to do slightly more. And that means that the turnaround happens faster and the retention happens faster. And what it does to Mahindra, it takes off a lot of burden that has been there on the balance sheet in terms of the investments they made to create this new platform for the last 18, 24 months. And in any case, the P&L has been showing signs of resilience and pickup from the tractor sales, as you rightly said. The other thing is that most of their sales are now coming from the premium SUV portfolio rather than the entry-level Boleros and all. So that is also kind of helping them out. But autos as a whole is something where there could be a lot of resistance from investors to buy into, given the fact that tariffs and all is becoming an issue. Of course, we really don't have much of exports from here, but there's always a sentimental, dilution that could happen on the sector post-April. But as of now, I think it looks very robust, and it could probably, not just today, but it could probably start inching up into a newer band of about closer to 3,500 from this 32, 33 that we saw last time.
Okay, that's M&M, and obviously this is a stock that Prakash has liked for many, many quarters. It's not a new call really in that sense. Prakash, I want to just stick to auto for a bit and talk to you about Samvardhana Motherson. We'll be speaking with the management as well a little later. The stock is some 40% off the highs. Numbers were, I think, okay, more or less in line with estimates. Margins at around 9.7% thereabouts. And we know that some of their markets are weak. International auto demand has been weak. But some brokers are saying that just the price is looking good now. It's all in the price. I don't know. Do you concur? And also, just tell us how one should be looking at some of these auto names that do have a very significant export focus, given all the tariff talk.
Yeah, good morning, Surabhi. So you're right. More than OEMs, it's the auto ancillaries that need to really worry about what's going to be unfolding on 2nd of April. Primarily, a lot of the businesses that rely on European exports have already been finding it very difficult to push volumes up. And if the US also, whether it's through Mexico or through some other jurisdiction, becomes difficult, it is going to be a big issue. Because remember, auto ancillaries, once they reach scale, it's extremely difficult for them to maintain margins if they don't utilize all of that capacities that they have built for OEMs. The other risk out there is I am expecting a big revival in terms of the interest globally from China, products from China, especially automobiles. Europe has been talking about reciprocal relationships and BTAs, so bilateral agreements with China, just for making sure that entry-level cars come to Europe from there, and they would sell the high-end Mercedes and the BMWs in the Chinese market. So there's a lot that could change in terms of shifts could happen in the market share. So auto ancillaries are definitely at risk. On Samvardhana especially, I'm sure the management, we'll have to hear the management in terms of their plan for the next few years. But the move towards greener technologies and supplying to green EVs and all of that is something which they'll have to do very rapidly, because conventional growth in IC engine, parts in IC engine is something you can't rely too much on. Most of the growth has come from acquisitions, and now it's time to digest all of that, consolidate all of that. So it'll probably go through a phase of consolidation in the business. I don't know about the stock. The stock would probably also reflect that same. But at this point, I wouldn't really get too excited to buy into it unless, the new plans the transaction plans start kind of getting very clear or crystallized very soon.
Okay, all right, got it. Prakash, stay on. We'll have more questions for you in just a bit. Do have to take a very quick break. On the other side, in fact, we're taking this conversation on auto forward. That's exactly the question. What lies ahead for both Indian OEMs and perhaps the entire auto ancillary chain as we talk of this whole tariff business with the US? Kranti Sambhav of Overdrive and Venkesh Gulati of FADA will join in with some thoughts. Welcome back. You're with us on Bazaar Morning Call, and the implied open. Let's pull up the implied open once again because it was now not in sync with the rest of the Asian screens, which are all quite positive, frankly. But anyway, the loss could be now less than 20 points. That's the indication. Cautious start is what we are perhaps in for. But let's stick to discussing the auto space and what this whole tariff business with the US could mean for Indian companies. US President Donald Trump has said that Harley-Davidson could not sell their motorbikes because of high taxes in India. And I mean, India has kind of taken reciprocal measures as well by reducing some of those taxes. We've started seeing that. Is there more coming our way? More clarity will emerge on the 2nd of April when we get exact tariffs from the US, reciprocal tariffs. And then it's going to be the negotiations whether India will start lowering some duties on, perhaps even full imports, EV imports. Will Teslas come in at lower duties in the Indian market? That's the question. Kranti Sambhav, Managing Editor at Overdrive, and Venkesh Gulati, Member Executive Committee at FADA, are joining in with some thoughts. Gentlemen, great to have you on. Kranti, that question first to you. Are we ready for the Teslas to roll in at much lower duty than what fully imported vehicles currently, attract?
Good morning, Survey, Nigel and Prashant. Yeah, so I guess this is what we have been expecting or waiting to happen. Teslas, they start coming to the Indian market. Last year, if you remember, we had lots of discussion on the, plant, establishing plants and giving some concessions for the EV makers, but that has not materialized. So now we should wait for the kind of rebates or discounts or the kind of relaxations we can see for these manufacturers, because Tesla is something which is still not very sure how it is going to enter the Indian market. But for Harley-Davidson, yes, that could impact a little bit, but most of the products which we saw they're selling, last year at least, this was produced with joint venture between Hero and Harley-Davidson. So I'm not too sure how much impact are we going to see on Harley, but yeah, for Tesla, I think we are all keeping an eye, and I think if we get some, if Elon Musk comes this time or he's serious this time, maybe we'll see Teslas as well. But I also feel that whatever rebates or whatever duty cuts we see for electric vehicles, other manufacturers are also going to be benefited from them.
Okay, all right. Fair point. Let me ask Venkesh as well. Venkesh, correct me if I'm wrong on the current duty structure. I think right now it depends on the cost of the car that you're importing in the country. And I think if the cost is higher than 40,000 USD, then I think the duty can be as high as 100%. Tell us what the latest numbers are right now. And again, that same question, if those duties are slashed, the way we've seen with bourbon whiskey, right, there is negotiation going on. So if import duties on EVs are slashed, then is it not going to be a problem for a lot of the Indian incumbents? When look at M&M, we just got to know about their booking numbers, which are good. But if you have these Teslas coming in at lower duty, then what?
Good morning. Thanks for having me. You are right. The import duties are 100%. But basically, those are in a category where they say that when a fully vehicle comes in as, and it actually covers only 2,500 vehicles if you want. If the duty goes less if you are doing below 2,500 as a trial. And this has been always. But practically, when we are talking of US, we have seen that a lot of US companies have not been successful in India, like Ford or GM or whatever. So obviously, whatever tariff discussions we are having will be majorly benefiting electric vehicle. Like Kranti said that Harley-Davidson issue is not big today because Harley is already in India through Hero, and they are doing good in the below 350 segment with the products they have starting to launch with Hero, and we are seeing tandem on the ground. you're right, EVs if Tesla come. But on the other hand, I think it would be good for India. See what happened. When Apple came into India, the mobile segment in India had matured itself. It has grown like hell. And it is helping India also as a consumer story also and make in India an export also. So if Tesla actually comes in India with the reduced duties and the support what today they are needing from the Indian government, it will actually help the EV scenario or the manufacturing scenario of India. Not taking any name of one OEM or two OEM, they all will benefit because their supply chain will improve. And as of today, EV in the passenger vehicle is just below 2%. And I feel we are all gaining towards 30% in 2030. Without a big disruption, I don't feel that we'll be able to reach that. So maybe this is the kind of disruption Indian government or an Indian public needs to get that EV adoption in a faster pace and an economical way also. And as of today, we are not sure if Tesla will really come below 30 lakh range or not. If they come, they'll obviously disrupt it. But if they come on the higher range also, they'll disrupt the supply chain side, not the retail side.
Okay, all right. So the point that you gentlemen are making is that, let the tariff barriers go. And if these imports do come in, if at all we have full cars being imported, perhaps even that to an extent, but it helps the overall ecosystem. Kranti, let's talk about the other piece now. What happens to automotive component makers? In both ways, I guess for the auto component guys, life is very, very confusing right now because one, you don't know how much tariff barriers are changing here for imports coming into India, and then a lot of these companies are very big exporters as well, and there doesn't seem to be too much clarity on what happens to the exports that are going to the US. Companies like Samvardhana, Motherson, and so many others. I mean, Bharat Forge, etc. So, what do you think is the overall auto ecosystem in for? As these negotiations go on, and what do you think the Indian industry would perhaps want to lobby for or ask?
Right now, Surabhi, what we are discussing or whatever conversations I've had, first thing is, as you mentioned, is the kind of clarity of the process in the sense what is going to be the final rate of tariff or on what components, because if we talk about India-US relationship, what Venkesh sir just mentioned is the number of vehicles from American companies are like really low, but and even Indian cars or Indian motorcycles, the exports is negligible. I mean, some of the manufacturers are exporting, but yeah, very nominal. But what we're seeing is that biggest chunk is the component business. But now, right now, all of us are basically sitting and waiting for the clarity. What kind of rates are we looking at? And we also feel that everyone is also working towards a mechanism where they can if there is a tariff going exports from India, you're going to see some kind of tariff. They might channel it via their other plants with whatever global plants or assembly plants or establishments they have. So what I feel is right now everyone is waiting and watching and trying to figure out. For example, if I talk about the OEM again, Royal Enfield also exports some 650 twins to the US, but they also have a plant or assembly plant in Brazil. So it'll be interesting to see how and what exact number of products or items are tariffed. And right now, I think none of us have that kind of clarity.
Okay, all right. Final question, Kranti, before we let you go. What about Mahindra and Mahindra's first day, first show, Valentine's Day? They launched the EVs and bombastic. What a response they've got. 8,000 crores of value and number of vehicles, more than 30,000 units. Wow. What do you make of it?
It because from last since I drove the car, after that the kind of questions I was getting, that we get lots of questions, which car should I buy, and most of the times the people customers, they expect me to talk about the ICE version, so I suggested ICE version. But I saw after the announcement from Mahindra, they started asking whether I should go for that or not. So what BE6 and XUV9 has done, I think that they have kind of changed the mindset of fence sitters. So this number is very interesting. And as Venkesh sir said, this is not only going to help Mahindra, this is also going to help other manufacturers, because I think this number is what, 30,000 numbers, even if there is a gap between, delivery and booking and delivery, which generally happens. I think the mindset, what Mahindra has managed to do, they have kind of, changed that. I mean, at least they've started changing that mindset. And I guess this is good news for EVs, good news for other manufacturers as well.
Absolutely. I mean, it's so normal and logical, a brand that you know and perhaps trust and perhaps you've driven before, and then for a couple of lakhs more, if you have an EV version, it's a very natural question, I guess, like you said, Kranti, that, should I just change over and move from ICE to EV? Thank you very much for joining an interesting conversation. Let's see how some of these issues unfold over the next couple of weeks. We'll take a quick break on that note, come back on the other side, and we'll have the pre-opening rates. We'll also be with our technical experts, Sudarshan Sukhani and Mitesh Thakkar, joining in with the market setup. Okay, we have started getting our pre-open rates. Oh, better not look at them. They're all over the place right now. This definitely the bulls will not want to see. The Nifty right now is 300 points drop. So let's ignore it. Let's give it a couple of minutes and go straight to our technical experts and talk about what the positioning could be. Mitesh and Sudarshan, good morning to both of you. What a brutal week we had last time around. And the question is now what? Sudarshan, if I could open with you on the index, are you taking a trade? Is there any point thinking long at this point in time? Or just ignore it, stick to stocks till there's clarity?
Good morning. Well, you said what I was going to say. There is always a trade. And today's trade is not to do anything. That itself requires a significant amount of discipline. And good traders exercise that discipline and say, there is no view in the market, so it's best to step aside. And unfortunately, even the stocks are not giving us the kind of setups that we want and that we want to trade in. So while there is something in stocks, the index is a complete no-go. Just stay away from it.
Not trade. That is the advice, at least as things open out, perhaps. That's Sudarshan's advice. Mitesh, good morning. What do you say?
I have a similar outlook. I think, the market is clearly not showing signs of recovery, despite the fact that last week twice we kind of bounced back from 22,800. But a sign of a proper reversal is yet to be visible on the chart. So the idea to trade is that if you get closer to 22,800, 780 zones, one can attempt a long with a 60-70 point kind of a stop loss. I think that's a low risk entry point, given the fact that historically we have bounced back from there. But on the upside, till we start getting up and capturing 23,150 on a closing basis and then 23,350, I don't see a big reversal is happening. So it will be just a short-term trade. But the bigger worry could be if 22,800 breaks on a closing basis. Then I think we are looking for a more kind of decline on the downside. So in that sense, I think the market isn't giving you a very comfortable signal. So trade with levels, but with very tight stop losses is my advice.
Okay, all right. Let's get to stocks, Mitesh. What's on your radar?
Morning, Nigel. I have more of sell calls today. Sell on Dixon Technologies with a stop at 14,380 for targets of 13,300. A sell on Ambuja Cement with a stop at 498 for targets of 470, and a sell on City Union Bank with a stop at 163.5 for targets of 152. The only buy call is Bajaj Finserv on a 10-12 point dip around 1830, buy with a stop below 1809, and look for a target of 1875.
By the way, it's been about 3-4 minutes, so have to report what we're seeing on the screen. I mean, I'm pretty sure this is not, it can't be as severe as it. Look at the pre-open rates, 200 points, 250 points down, very, very unlikely. Perhaps this will settle. So let's give it another 4-5 minutes and then come back to it. But right now, it's a little all over the place, still on the pre-open. Sudarshan, just checking again, though you said that, it's best to stay away for a while. Any stocks at all, mid caps, large caps, anything that you're looking at individually?
Yes, we do have stocks. You have to use your own discretion. But like Mitesh, most of them are on the short side. MGIL is an intraday short, stop above 1260. Vedant, again, another intraday short, stop above 420. And Kalyan Jewelers, a stop above 495. For Kalyan, you need to check up whether it is in the any kind of lists or not. I have not checked that. And I have one buy idea. Now, that is Indigo. Indigo is giving some bullish patterns. Now, they may or may not work. I don't have a stop because you have to use your own judgment. But it's a positional trade. But Indigo could be worth buying into, and the other three are shorts.
Okay, all right, gentlemen, thank you very much for joining in. We'll come back to you a little closer to market open. Let's, for the timing, head across to Prashant, who's on the wall now to talk about this big India underperformance. And Prashant, this is something we're not used to talking about, and we've been saying it for a while. This phrase itself, India underperformance, refuses to go away.
Absolutely, Surabhi, but I think that is also because the reason that we became too used to and comfortable with India outperformance all the time, right? In 2000, and you have to go back and look at the last 3 years, and I think it would be true. But I thought it's just worth highlighting and pressing on what's happening globally as well, because globally it's a bull market. Markets which have not performed for 20, 25 years are coming back. And actually, maybe that is the reason why there is some demand for foreign capital elsewhere. It is no longer, we used to hear a year and a half back that word TINA, there is no alternative. But there are alternatives now. There's China, there is Europe which is starting to come back like the come back from the dead, basically, right? But let me just quickly put the numbers up. And it's the same thing that I put out in the morning, but I just wanted to look at this last point. I mean, this is all okay. When the crunching fall, we know this, right? Last week was absolutely devastating. 2025 so far, again, big damage. But what this has done is that, the 10-year CAGR returns for both the mid and small cap indices have now fallen to 14 and 11%. This is around long-term averages of what equities give you. 12, 13% is what they give you over long period, 25-year. You can go back and look at returns. And we are now coming back to kind of those levels. This is, of course, just indices. And also, I think this is now, barely above the cost of equity. So, at an index level, now I'm not saying that, well, because this has happened and this is some magic signal that stocks will stop falling. That's not the point. But the thing is, all that excess froth, excess returns, if you want to call it, and many people will take issue with the fact of what is excess. There's nothing excess. It is what it is. But the point is, compared to the longer-term average, some of that has been actually, is gone now, and this is what the numbers look like. Now, just a couple of more points, and I said this in the morning as well. Impossible. Many people are still saying, well, maybe the bottom and is around the corner. It's impossible to call it. We'll only be wiser in hindsight. That's the nature of things. But one thing we know is that there is no real macro risk in India in that sense. That I think one has to be absolutely clear about. Foreign selling has been very large. These are not new numbers, but it's stabilized recently, right? I mean, FI selling has stabilized recently. Asia funds are underweight. Positioning sometimes is important. In the case of China, for example, it's worked in a big way. The huge underweights now starting to come back to market weight. They're underweight, whereas EM funds, which is the main source of money for India, are only modestly overweight now. And again, that excess positioning is all gone. And the last point is this global bull that I put up, right? So global markets are in a bull market. And this is not just the US. Actually, if anything, it is S&P 493, which is starting to fire up. Mag 7, those 7 stocks are starting to taper off a little bit. And these are returns year to date. This is the Hang Seng benchmark, the European 50 stock index benchmark, S&P, and this is, of course, the Nifty. And these are year-to-date numbers. And I mean, to that point, the Euro Stoxx 50, if somebody started working in Europe as an analyst in year 2000, for 25 years, that person has not seen, those levels come back up, and they're starting to come back now. It happened on Friday. So it kind of tells you that maybe there is a little bit of competition for capital, foreign capital as well, which is starting to emerge. But of course, earnings, etc., will have to pick up. Their earnings growth in Europe is 4.5%, 5%. So, that obviously can't sustain, but that's the situation right now. Back to you.
That's a sobering thought. 10-year CAGR coming down to 10, 12%, 13, 14% kind of levels. And you add tax to it, 12.5% capital gains tax. So what is your net return? That's a big, big question that maybe many foreign investors are asking now.
Well, that's right. Some caution on board, but let's focus on bourbon whiskey. Yes, Monday morning, we're focusing on bourbon whiskey because the bourbon whiskey that will be imported from the United States taxes will reduce significantly as the import duty could fall from around 150% odd. To discuss tariffs, the impact on the Indian liquor industry, we have Abneesh Roy, the Executive Director at Nuvama Institutional Equities, who joins us on the show. Hi, Abneesh. Happy for those who drink bourbon. It could come, particularly from the United States, it'll be coming in at a cheaper cost. But first, give us a couple of details. Some reports indicated that the market is not too large itself. So what is the number, the total quantum of imports of bourbon whiskey coming into India? And out of that, how much is the United States?
Yeah, thanks. It's an interesting development. I think it's quite small. India definitely the key segments will be essentially the whiskey, which is Scotch whiskey, etc. So I think this is more of the visit which Indian Prime Minister made to US, and those concessions keep happening. Our sense is bourbon whiskey is too small. It doesn't really impact meaningfully overall scheme of things. Having said that, we are quite positive on the liquor sector, liquor consumption from the next 1 year, 2 year, 3 year view. We are quite positive. In fact, in our top picks, we do have both the two key companies, United Spirits, United Breweries, and we do see coming quarters in the current slowdown, for example. Everyone is speaking of slowdown. But if you see even in December quarter and March quarter, you will see strong numbers from both these companies. So we are quite positive on United Spirits, United Breweries. In the other discretionary space, we like Britannia, Nestle, ITC, and HUL also. Coming back to your question, I think it's a positive development. Ultimately, I think Street is watching what's happening in the UK FTA trade agreement. That is the big one, because that will impact essentially favorably in terms of the raw material cost and pricing in terms of the Scotch whiskey. But bourbon whiskey is too small, few $1 million.
All right. So I think back of an envelope, I think reports indicate is less than $3 million, right? Bourbon whiskey coming into India.
Yes, yes.
And what is the total imports of whiskey into India? And out of that, how much is Scotch, as you were just briefly mentioning?
For India, if you see the local IMFL is the big one. All these, especially the Europe whiskey, etc., will be again broadly 6-7%, high single digits maybe. So I will say bourbon whiskey will be a very small component of the overall imported whiskey. The bulk is essentially what the liquor companies produce in India in terms of the McDowell's and Seagram's, all those portfolios. Those will be the bulk. Even if you see Pernod, which has been in India for a long time, the Indian acquired brands which they got from Seagram, they are still bulk of the portfolio. So I will say still these are small numbers. But yes, in terms of the UK FTA, whenever that happens, I think it will be positive for United Spirits and the other spirits companies also. This US development, I think, is more of a tick mark in terms of the US-India relation. It's a positive development, win-win situation for both. But liquor sector, I think it doesn't really impact.
Okay, all right. Let's focus then, the domestic factors. As you said, you're bullish on United Spirits and United Breweries. Now, United Breweries had a bit of a tussle with the Telangana state government. They said they're not going to be supplying more. Now, what's happened is they've got a price increase and they've also got some of their dues that have come back. So, good strategy out there. What's your view on this price increase? Was it on par of what you were working with, or is it a little bit higher? And also their dues coming in, how positive is it?
Yes, definitely. The new MD, Vivek Gupta, is doing a commendable job, both in terms of engaging with the stakeholders and new launches. Coming to Telangana, you are absolutely right. This is a positive development. I think 15% price hike is not at all bad. Of course, the companies will always want more. But if you see on a 4-year basis, 15% hike is a very good number. My sense is still profitability in Telangana is not to the desired level, but it is from a loss-making business, it becomes profitable. And if 17% of the pan-India business is from Telangana and that turning profitable, I think it will have a meaningful impact. And company will work to improve efficiency, put up bigger distilleries, and definitely work at improving the efficiency, which they have done even in December quarter. So yes, we do see that this market share gains, and if you see Heineken is doing quite well in the different states. We see United Breweries doing well. Of course, margins were disappointing in December quarter, but that's because they are investing in the premium end with more bottles, etc. That will even out over a medium-longer term perspective.
Avnish, quickly then in 10 seconds, to quote Nigel's line, in a market like this, you need both Dawa and Daru, which is your favorite Alco-Bev stock, if at all. Any buys? From and this is a medium-term portfolio stock perspective.
Yeah, in the Daru, we like United Spirits and United Breweries both. In the staples, we like Pidilite, Hindustan Unilever, Britannia, Nestle, ITC. And near term, margins will be under pressure for Godrej Consumer, Tata Consumer, Bikaji. So there, I think, slight caution from a near-term perspective.
Both spirits and breweries on the Alco-Bev side. Got it. Thanks, Avnish, very much for joining in. Let's very quickly go back. I think we have Mitesh with us for some final thoughts on the market before we start. By the way, the pre-open is still telling us that we're going to start fourth time testing this level of 22,800. 100 points gap down at a day when Asia is absolutely fine. Mitesh, what's your advice?
I think, let's see how the level again holds up. In case you see a reversal on the half-hourly chart, maybe a long can be done. But again, as I said, I'm not looking at a big reversal. In fact, I'm more worried about the possibility of us breaking below 22,800. But for the timing till that level is holding, you can always try along with the 60-70 point kind of a stop loss. And on the stock side, Dixon Technologies is a sell for targets of 13,300.
So single bottom, double bottom, triple bottom, quadruple bottom. What is that?
This is going to be fourth time. Quadruple. It will be a quadruple bottom, right?
But not yet. We're not yet. Oh, we're starting on that. 22,800.
That's exactly where we are. Let's see. Holds or not. They said double bottoms markets turn, then triple bottoms markets turn. That's quadruple bottoms, you know.
All right.
Hang in there.
All right, we'll have a 120-point lower start, 100-point lower start. 22,800 is where we're at. The sensex is down about 300 points. First rates coming up on your screens. And here we go. So 22,930. And it'll start to, the prices will start to come up more firmly. About a 0.5% cut, 22,800. 22,780. So around there, basically. Last week's lows. Nifty Bank is down a 0.5% as well. The IT index is down about 0.7%, and straight up 2:1 declines to advances. Straight out the gate, 3 stocks are higher, and majority of the stocks are starting in the red. And now it's a 1% cut, by the way. 260 points lower. 22,780 is where we are at. 22,786, of course, is that low that we got to on the 27th of January, and which we kind of sort of tested in a way on Friday as well, and from where we bounced. So it's a firmly lower start to begin this session. Surabhi.
Okay, let's quickly look at what's taking it down. 176 points, 186 points low right now. M&M, 3% down. BEL, Tata Steel, Shriram Finance, ONGC, it does not matter. NTPC, Hero Moto. It's across the board. It's absolutely indiscriminate. Apart from Sun Pharma, Cipla, there's hardly a red tick. This looks like a huge sell order has been executed first. I mean, someone was sitting with a huge sell basket, decided to just go slam dunk on the Nifty. It's not about sectors, it's not about stocks. Now we are 200 points down. I'm at loss for words, Nigel.
Well, that's right. In a few stocks, actually, that are taking it very, very hard on the chin, I think. So, Utkarsh SFB, that stock's down close to around 12%. RVNL, that's down close to around 6%. I think it's reacting to its numbers. So, big downtick is what you're seeing out there. Ircon as well is pulling back in today's trading session. So a couple of these names have come in for selling. REC and PFC, they went one way up. Both of them have come in for some selling. What's done a bit of a U-turn? Manappuram Finance. The stock was down close to around 10% on Friday's trading session. That's pulled back close to around 3% in today's trade. So keep an eye out on that one. GSK Pharma, that's up close to around 6.5%. So good move is what we're seeing out there. Volumes fairly okay, actually, for a counter of this size. So, that one as well is up close to around 6% as we speak. And otherwise, the breadth of the market is, dismal at around 250 stocks that are advancing for 1,850 stocks that are declining. A quick word on, a couple of stocks that are under pressure. D Development, that's one of those IPOs that listed, I think, in the last 12 months or so. That's down 20%. That's in reaction to its numbers. And these sort of accidents make markets very, very nervous. Best Agro, that's another one that's down close to around 15%. And Zen Technologies, I recall they raised money at much higher prices. The stock had gone all the way to around 2,200 odd. Now it's close to around 1,100. So that's the kind of selling that you're seeing. Some of this selling has to do more with regard to trading positions, I think so, rather than fundamentals. As we speak, big downtick is what we're seeing out there. Stock down 20% as we speak.
All right, well, let's go straight across to Sanjeev Prasad, who's now with us, Managing Director and Co-Head at Kotak Institutional Equities. Sanjeev, good morning. Great to have you back on the program. Thanks very much. And, wishing you all the best of luck for the conference. And I think you'll get, I'm sure, lots and lots of questions. You were, of course, early on and steadfastly cautious through, I dare say you were wrong for a while. But I think now, of course, it's out there for everyone to see. So where does, after what we've seen in terms of the correction, the small cap index has lost about a quarter of its value from the highs. The mid cap index has lost about 20% from its highs. Where does it leave us, pure valuation wise, Sanjeev?
Well, it's the same thing which we have been saying for the last 1 year or so. And if you look at the valuation of the large cap index, let's say the Nifty 50 index, it's not too bad, roughly about 20 times 1 year forward, about 7.5 on a March 27 basis. There will be earning downgrades, I'm sure, in some of the sectors. But broadly speaking, I don't see too much downside, as far as the the large caps or some of the large caps are concerned, namely the financial names, IT, pharma, etc. Yeah, there are still pockets of overvaluation even in the large cap, but I can live with that. The problem still remains in the mid cap and small cap, areas that is sector dominated by mid cap, small caps or the mid cap, small cap stocks. Still a lot of froth over there, and I think you would see a lot more correction over there because the fundamental value of many of these companies are far lower than whatever the current market caps and prices are. I mean, you talked about RVNL. Just now. I mean, the market cap of the company is something like 75,000 crores even now, by the way. Yeah? I think it is still at about 8 times book value, if I remember the book value correctly. Yeah? And about 40 times on March 24 profits. And the railway budget this time around, there's no growth in the railway budget, right? So where is the growth going to come from for some of the railway stocks which had become very, very expensively valued? So there are still pockets of, I would say, froth in the market, and that will get flushed out over the next few weeks. Looks like the way the market is going.
Sanjeev, this I was looking at this data point in the morning. If you look at the small cap index, right, with this correction we've seen, the 10-year CAGR now has fallen to about 11%, which is in line with the long-term average now. The mid-cap CAGR 10-year is now about 14%, is 14%. Again, it doesn't seem, I mean, that excess or excessive kind of fraud seems to be out, but of course these are averages. The other point is markets really settle at averages, right? They overshoot and then they undershoot. But you're saying on an absolute basis as well, and you gave us that example of RVNL, there are large pockets of overvaluation and excesses, right?
Absolutely. Yeah. There are just so many stocks here, especially in the mid-cap and small-cap areas, So either you have, companies which are trading at very expensive valuation but have decent fundamental. These are the high-growth companies, let's say in the capital goods space, EMS, etc. But we just struggle with the valuation of these companies, and they are so much priced to perfection, even now, by the way, despite coming, down 20-30% from their peak level. So any disappointment, you would see a big, cut in the market price over there. And then you have many other stocks which are not displaying any great, numbers, especially on the consumption side, and the valuations are still very, very rich. And in most cases, the multiples are significantly higher than the pre-COVID levels, and the growth is significantly lower than the pre-COVID levels, so which makes no sense really. And in many cases, you are seeing a lot more disruption, medium-term challenges, structural issues cropping up, which were not there 5-7 years back when the market was willing to give much higher multiples to the same sector in stocks. And then you have a bunch of completely rationally valued, sectors and stocks which have no real fundamentals, but the prices have gone up, very high for whatever reasons, and now they are giving way, and these will correct really, really badly, And unfortunately, a lot of retail money is over there from whatever I've looked at some of these stocks.
Which are these, Sanjeev? The ones that are looking absolutely still insanely overvalued and where earnings are just not justifying?
Just
or which
at,
pockets? I mean, if not stocks, which pockets?
Some of the PSU. Look at the PSU names in railways, metals. You will get a very good sense.
Okay. By the way,
I mean, not the large cap ones like let's say.
Yes, please continue. Please continue.
NTPC, Power Grid, etc. may be okay, more reasonably valued now. I was just saying NTPC, Power Grid, etc. may be more reasonably valued. But look at something like a BHEL, which we have been sounding cautious for the last 1.5 years now. The stock went up from whatever, less than 100 to 300, now down to below 200. I still think it's supremely overvalued. It will come to below 100, or rather, I should say, I can't forecast stock prices. The fair value of the company is below 100 in my view. Right? Still my view, but that's what it is. And I can give you the math on that, but anyway, let's keep it for a
Got
second.
it. You're saying even within PSUs, there are the likes of NTPC and Power Grid where you think now the corrections made the prices a little reasonable, but BHEL you'll hold your verdict on that one. By the way, just want to report that from a very sharp gap down, now there's an equally quick recovery in the market as well. Should take note of that. There's a V-shaped recovery right now on stocks like Bajaj Finance, Tata Motors, Apollo Hospitals, NTPC, the stock that Sanjeev was just talking about. So we had this slam dunk, and now the buyers have quickly crept in, and those charts are suggesting that. Sanjeev, just very quickly, at a headline level, I was looking at, for instance, some of your peers, Motilal's note, they were saying for FY26, the Nifty estimate is around, I think, 1203, 1,203. and they feel that expecting a 15% CAGR is very excessive right now. Where are you on the headline earnings trajectory for FY26? Whether it's the Nifty 50 or the BSE 200, some of the wider indices, what is that big number that you are going with?
So for FY2026, we have 14.9 or 15% growth, let's say, rounded out to 15%. That's on the back of 4% growth in FY2025. But anyway, 2025 numbers are distorted by, much weaker numbers for the likes of BPCL, HPCL, which is not part of Nifty, but through ONGC, these numbers come. And also coal had, very high numbers in FY2024. You will have a big decline over there compared to FY2024. So if you look at without these three companies, which is probably right to look at it because there's a lot of volatility in the numbers of these three companies, then the FY2025 net profit growth will be 10%. And for FY2026, now, as of now, we have 14% growth. And I think the EPS number is about 1180 or so for FY2026.
You're
so
saying
again, the Nifty is not a problem.
Nifty...
If you look at the banks are reasonably...
Sorry, Sanjeev, you're saying the Nifty...
14% growth if you take...
Yeah. And X of which companies did you say that the growth number comes down to 10%?
BPCL, HPCL and Coal India. HPCL is not in the Nifty, but its numbers get consolidated with that of ONGC, and ONGC is in the Nifty 50. And there's a lot of volatility in the numbers of these companies. By FY2024, if you recollect, you had very, very high profits for BPCL and HPCL. And also coal had this one-time benefit from the change in their accounting policy for the overburden removal, which boosted 2024 numbers significantly. Which is why if you look at the FY2025 headline number, it is only showing a 4% growth. So that's why we now remove BPHP and coal from the calculation completely. And if you do that, then the FY2025 Nifty net profit index, Nifty 50 index net profit growth comes to 10%. And on a like-for-like basis for FY2026, it comes to 14%. So there will be some downgrades, but I think 12-13% it seems achievable for the Nifty 50 as a whole. See, Nifty 50 again is not a problem. You have companies, like the banks, etc., which are not seeing really any challenges as of now. Or especially the banks which are Nifty 50. There are smaller banks who are seeing a lot of issues in the MFI, loan book, and so on and so forth. But there are no real asset quality issues as far as the larger banks are concerned. If you look at IT, pharma, which are another very large portion of the index, they are getting some tailwinds from the big INR depreciation that you have seen, and some recovery, and anyway, pharma companies are doing quite okay. So that's not the problem. The real problem, as I keep saying, is beyond the large caps.
Okay, all right. Hi, Sanjeev. Good morning, and always good to hear your thoughts. And congratulations, actually, on being a little bit cautious, particularly calling out some of these PSU names. You were in minority actually at that point of time, but a lot of this has played out. But let's talk about a couple of spaces that I think you are fairly okay on in. Quick commerce, Zomato, everyone was very, very excited about it. It could be one of the stocks that come into the Nifty as well. That stock has pulled back a goodish bit. Even Swiggy, after it listed, the stock went up 50%. And now it's below the IPO price. What's your view on this quick commerce theme? It's making consumers' life a lot easier, but from a shareholder perspective, what's your view?
No, we continue to like the space. See, these are long-term growth stories. If you look at, let's say, food delivery business, it's now a nice market, only two companies now, basically, Zomato and Swiggy. And if you look at the growth drivers over there, unlike, let's say the FMCG companies who are seeing a lot more competition coming in, fragmentation of market share, etc., here you don't see any of those challenges. So you are seeing, a triple combination, I would say, of more number of users, more frequency of usage, and higher AUV, that is average order value. And each of these levers, if you take 3-4% growth, which should be quite achievable in India, in a country like India, given its growth prospects, the combined growth actually becomes very, very decent. We are talking about 15% plus in that case. If you have three levers, each growing at 4% plus, that's the kind of growth we are looking at. The challenge remains on the quick commerce side because obviously, this market structure is still not evolved. You're seeing a lot of competition, a lot of cash burn over here. I think it's a matter of 1 or 2 years before things start settling down. Obviously, things could get a bit more nastier over here. So that's why I keep saying, you have to look at these companies from a more long-term basis. The growth is there. The structural story is very, very powerful, both in the food delivery and the quick commerce part. But yeah, things could, given the challenge around the quick commerce business, the path to profitability has got, extended now. Compared to earlier, we were looking at, let's say, break even in 12 months' time. It will probably be more like 24 months' time for all you know. I mean, I don't know. It's still evolving, the whole space. And we don't know what the likes of the e-commerce players will eventually do over there, or the modern retailing guys, what they will do over here. So you could eventually have a 6 or 7 player, a market, all fighting, for the consumer wallet. And, things could remain, in a state of flux for some more time. So yeah, so that's what is reflecting in the stock price currently, not the concerns around long-term, any challenges,
All right, no, absolutely. Sanjeev, the other question, and you'll have so many foreign investors also at the conference, right? Foreigners have sold some $21 billion of Indian stock from the peak in late September last year. So this year, I guess, we're giving back some of the crazy run over the last few years. But global equities generally seem to be, we're looking at Europe, for example. The Euro Stoxx 50 has come back to its same level as year 2000 after 25 years. Things are rising from the dead. China, for example, has started on a good note. Mostly tech, though. Does this mean more competition for this foreign capital? Because there was this argument which was made last couple of years that, there's only US and India, and that played out, for a while. Where do you stand on foreign flows, Sanjeev, from here on?
The foreign flows, I suspect, we should assume for the time being it's not coming back in a big hurry. And the reason for that is pretty simple. There is no new money coming into emerging market funds for the time being. And I don't see why that situation should change in the next 2-3 months at least, given the fact that the US market is doing very well. We have a lot of, policies which are still evolving, as far as the new US administration is concerned, which could work against the EMs for, if you see more, tariff being put on exports from some of the emerging market countries. So as of now, I would say most asset allocators would be a lot cautious on emerging market. And that's been the theme for the last, 3-4 months now. This whole thing started from late September when, first of all, I'm talking more from India perspective, first you had the India to China pivot, when China announced a host of policy measures, fiscal and monetary, to reboot the economy. And very quickly, by end October, when the chances of Republican Party winning all the 3 arms of the US government, started to build up, the so-called Trump trade, you had a pivot from EMs to the US. And that trend, unfortunately, has continued, from a perspective of EMs. And you see the fundamental problem still remains the same, right? If you look at the performance of emerging markets, it's been a disaster for the last 10 years. The MSCI EM index is up 13% in the last 10 years, cumulative that is, which means 1% CAGR. Against that, the S&P is up 200%, so that means 3x. NASDAQ is up about 300%, that means about 4x, by the way. So that's the comparison an asset allocator, which could be an endowment fund or a pension fund in the US is looking at. And everybody looks at trailing returns, and decides, okay, fine, US is the market to be in. Plus, you don't have worries about, currency and so on and so forth. So why bother? And I suspect that may continue till the time either something goes wrong in the US, but obviously then it means pain for the rest of the world also. Or, somewhere EM valuation come to a level where, people, start looking at a lot more favorably, which is what seems to have happened in the case of China at least. Valuations were attractive. Certainly you have this excitement around, DeepSeek and AI-related tech. You have seen all the tech companies, bouncing back, and also China has decent, tech companies. So that is excitement now, but remember, it is basically the same money which is rotating between various EM markets. And unfortunately, India will not get any money in the process, because if China's market is doing well, India will probably struggle, which is the second leg of the problem. So first you have an EM to US problem. Second is, as of now, looks like again you have India to China pivot, which is going on.
Absolutely, and that's showing up in those numbers, right? 14-15% up in the Hang Seng, multiple woes, and that's a real sobering thought, Sanjeev. Final question, where does it leave us then? Does it leave us, is the best case a time correction? The market does nothing, spends the whole year consolidating. Is that the best case? Or is there still the possibility of seeing more downside, despite the mutual fund support that the market has got the last so many months?
It ultimately depends on how the retail investor, takes this period of pain, which has been there for the last 12 months now, come to think of it. If you look at the Nifty 50 mid-cap index, Nifty 100 mid-cap index, I think it's up only 3% in the last 12 months. Nifty 100 small-cap index is actually negative last 12 months now. So, and the last 3 months have been pretty ugly for both mid-cap and small-cap indices and stocks. See, there are some interesting data points. If you have the time, I will share. See, there are two issues over here. When people believe Indian retail investors have done very well, keep in mind the fact that you have a lot of new investors who come to the market in the current financial year. About 8 million out of 53 million unique mutual fund investors have come in the last 9 months. Yeah, and these are investors who I don't think will have the risk appetite to bear a big market correction. So how they are behaving, I don't know, but I'm sure there could be some signs. I suspect there could be some signs of panic over there. The second more interesting data is when the money has come into mutual fund, by the way. Yeah? So if you look at last year, that is calendar 2024, 4 trillion rupees came into mutual funds, equity mutual funds. And that is not very different from the cumulative numbers of 21, 22, 23. 1 trillion in 22, 1.6 trillion in 22, 1.6 trillion in 23. So that's about 4.2 trillion. So the more important point is, if you look at the weighted average price of acquisition of retail investors, it's actually quite high, not as is made by the return. So it's not as a retail investor sitting on a lot of great returns. When they put money also matters. Who has come into the market of late also matters. There is
so more downside. So is there more downside?
I don't know. I don't know, Baba. See, who knows the mind of retail investors, right? If they are reasonably, confident about the future, they stay invested. But if they start panicking based on whatever we have seen last few weeks, then I don't know what's the bottom of the market in that case.
That number is, Sanjeev,
especially
8
for some
million.
of the low quality, low liquidity.
Yeah, 8 million out of 53 million unique
the data
MF
again,
investors.
Yeah. Came in the last 9 months, and they are probably all lost money. Yeah.
Yeah. And the other point?
The market is down since then, no? So clearly they have lost money.
Yeah.
4 trillion rupees has come in calendar 2024, which is similar to the entire money which has come in calendar 21, calendar 22, calendar 23. So the point is the weighted average cost of acquisition of stocks through the mutual funds is actually high. It will not be very low. So the index looks very good on a 3-year basis. I don't think individual portfolio returns will look that good on a 3-year basis, because when you put money also matters, right?
Absolutely.
If you have put money in 21, you would have been sitting on a lot of gains. If you put money in 24, you have lost money actually. And if you put more money in 24 versus in 21, then your average return will still be not that great, right?
Yeah, absolutely.
The question is, if you put in 2025, is it a right?
The retail investor has to deal with.
The question is, Sanjeev, is in 2025 you're getting a bit of a dip. How much more pain will you make money from here on? That's going to be important as well. The entry is extremely important. And sometimes, periods like these, it's anyone's guess which one it'll go.
It's a long way to go. For the mid cap and small caps, be very, very careful. Yeah.
Got it, Sanjeev. Appreciate.
Ultimately, you have to be very focused on value. Yeah. Okay. Thank you.
Absolutely, Sanjeev. So maybe. The large caps could be protected to some extent, but mid and small caps, there could be a lot more pain in store. Thanks a lot for joining in, Sanjeev, and giving us some of those sobering thoughts as well on the markets. By the way, when we were having that chat with Sanjeev, the advance decline ratio moved all over the place. At one point of time, we were less than 250 stocks that are advancing. That number went to around 1,000 stocks, which is back down to around 550 stocks that are advancing as we speak. But just looking at the screen, it appears, select stocks, they got hit just purely because of selling at the open itself. Bajaj Finance, pull up the intraday chart, stock was down 4%, now it's moved into the green. Tata Motors as well has seen a big pullback in trade. That as well was lower. Coal India as well. Mahindra and Mahindra, we're talking about those good numbers that they deliver. Take a look at the stock, it's down 4.5%. That's the kind of market we are in. The news is positive, but that stock has come in for some selling. Well, let's talk about BEML. That's the one that's on our radar. The last couple of quarters, the numbers have been a little bit disappointing. They were earlier guiding for close to around 20% revenue growth. But as things stand, as of 9 months, it's actually a bit of a degrowth. So understand how's business shaping up. We're joined by Mr. Shantanu Roy, the Chairman and Managing Director of the company. Hi, Mr. Roy. Good morning and thanks a lot for joining in. Well, last few quarters, performance hasn't been great because of the execution problems. But now we're looking at quarter 4. what kind of a revenue number can you deliver? Your first 9 months, the revenue degrowth is close to around 7%. To even match FY24 numbers, you'll have to do revenues of close to around 1,700 crores. So what do you end this year with? Are we likely to see a flat number in FY25 in comparison to FY24, or are we bracing for a degrowth? Please go ahead, sir.
Good morning, Nigel.
Morning.
It's very good to be back with CNBC-TV18. Yes, the numbers have not been very good the first 9 months. But let us understand, we have 3 business verticals. And out of the 3 business verticals, the mining and defense have done very well. The rail and metro has been down by almost 50% as compared to last year. And in spite of that, the company has held its ground. And that talks about the resilience and the versatility of the company. We still have 45 days to go in the current year. And we are working towards, the aspiration that we have. And, if you look at the most positive aspect, that is the order book. If you look at the companies, if you look at the order book history over the past 5 years or so, never before have we crossed 5,000 crores except 1 year. And last year it was 7,000 crore of order inflow. This year we are already at around 6,000 crore. And the coming 45 days, it will be another 3,000 crores. The highest ever order book growth, highest ever order inflow for the company in a financial year. That is what we are going to achieve this year, which talks about, the long-term value that the company is going to create. So yes, quarter-to-quarter financial results are very important. It's very important for the investors. But at the same time, the kind of value that BML is creating, that is phenomenal. The value in terms of the deliverables, the bullet train, the high-speed train, the Vande Bharat sleeper, the engine for the defense forces, the indigenized high-end mining equipment. So that is a long-term value. And it's a test match, basically. So test match, it takes time.
Okay, all right. But, on a day-to-day basis, we need to see how the test match is playing out, right? So let's focus on the initial session itself. That is the upcoming session, FY25, what you'll end with. You have done roughly around 2,300 crores. Earlier, going by the projections, from 4,000 crores, you should have ended the year at around 4,700 to 4,800 crores. So realistically, for this year, what will you end the year with in terms of revenues? Point number 1. And you had indicated that margins will improve by around 100 basis points. It's in that vicinity of around 7.5 to around 8%, 7 to 8%. So are we on track to see margins further improve from here? Revenues for this year, for next year, as well as margins. Please go ahead, Mr. Roy.
You see, Nigel, as I said, we are in the final few days, I would say. And since the third quarter, the growth has been quite phenomenal in the month of January, as well as what we have seen in the first 17 days of the current month. And with rail and metro, it is on the verge of firing. So I don't see any reason why the company should not do well. As I said, we still have around 45 days to go for the current financial year to end.
Mr. Roy, so you'll end this year flat? This year flat revenues, FY25 versus FY24, which would mean you'll have to do 1,700 crores in quarter 4. That's possible?
I did not say that we will end flat.
No, I'm asking you.
I believe that the match is not lost till the last ball is bowled. Okay. We have the orders with us. We only have to focus on execution, and that is what we are doing. Our current order book, as it stands, at around 15,000 crores, out of which 60% comes from rail and metro, 30% comes from defense, and 10% comes from mining. And the coming 45 days, the order that we are expecting, whatever mining orders we get, that we are going to execute in the current financial year itself.
Okay. So we shouldn't rule out a 10% growth at least for this year, given that you'll be batting right till the last ball. Some growth in FY25 versus FY24?
Nigel, you're trying to put words in my mouth, but let's wait for the results. Definitely there will be growth. And,
okay, there will be growth.
Definitely there will be growth. And as far as the EBITDA is concerned, 100 basis point EBITDA that I had given a guidance. We are working towards that. And let's see how the next 45 days turn out for us.
Okay, all right. So at least there'll be growth in FY25 versus FY24, but you're taking it down to the wire. So we'll have to see how much of growth can you deliver. So we'll wait by for that. Also, just to confirm, the order book is around 15,000 crores, and you're talking about incremental orders of, I think, 3 to 5,000 crores. There'll be some execution as well. So you'll end the year with an order book of close to around 18,000 crores?
Yes.
Okay, got it. Also, just a word on your working capital days. That got a little bit, went up a little bit, I think, to around 260 days odd. I think normally it was in the previous year, in the same quarter, was around 230 days. Apologies for that. Do you think things will improve from here on? What is the working capital days we should be working with?
You see, the working capital has always been a concern. And one of the biggest reasons of the working capital going up was the inventory that we had built up, and which we will execute in the last quarter. Once we are able to do that, we are also working on reducing our debtors on a mission mode. Once that is done, I am sure the working capital, when we end the financial year, will be better as compared to last year. And also, when the company is in a state of transformation, we are undertaking so many development projects. We are undertaking so much capital investment. So sometimes, definitely, yes, it happens that the working capital it gets stressed. More so when we have not gone for a long-term debt in spite of going for a huge capex. So, but that we are going to change next year. We are now planning to go for some long-term debt to fund our capex infusion. So that will ease out the working capital in the next financial year to a great extent.
All right. We'll leave it there. We had more questions, but short on time. But good luck as you execute. Continue to execute, and hopefully, we'll see some sort of turn as far as the stock is concerned as well, because the business seems to be in decent shape. 28.31 on BEML, off the highs of about 5,500. We'll take a quick commercial break here. Up next, we connect with the management of Samvardhana Motherson International. We discuss their performance for the quarter gone by. Stay tuned.
Welcome back. Well, the top loser on the Nifty actually is Mahindra & Mahindra, and they had declared their first day, first show EV bookings, which actually look quite good. But it appears the street wanted more. Sudarshan joins us to break that down for us. Sudarshan.
The stock is top Nifty loser, down around 5%. It's despite strong booking. This company has disclosed for its recently launched two electric vehicles, that XEV9E and BE6. Company has received bookings of around 30,200 units with total booking value of around rupees 8,500 crore. If one reason I can attribute to it might be profit booking, because company stock has outperformed its peers. If you look at the performance of all the auto companies in last few months, even most of the brokerages remain positive on the stock. Citi has a buy call with a target of rupees around 3,700 per share. It says absolute volumes of BEVs much lower than some of recent models launched. It says, but needs to see how the EV facility ramps up and what is cancellation rate. Nomura too has a buy call target is around rupees 3,700 per share. It says impressive start for BEVs with 30,000 bookings. Co has received 56% and 44% bookings for 9E and BE6, and 30,000 order book is a very strong number that company has received. GS2 has a buy call and target is rupees 3,800 per share. It says 30,000 bookings to imply 8% incremental SUV volumes for FY26, and BE6 and XEV9E models to collectively contribute 8% and 18% to FY26 SUV volumes. Elara too has a positive note on this. It says 30,179 bookings seem to be very good. So overall, all the brokerages remain positive on the stock after the company has received bookings for its EVs, but stock is under pressure, down around 5%.
All right. A little recovery from the lows, but 3.63, about 4% lower still. So thank you very much for that. Let's stay with auto. Samvardhana Motherson is the next company on the radar. Third quarter numbers largely came in line with expectations. Margins were higher than estimates. They've also witnessed a sharp reduction in gross debt. We are joined by Pankaj Mittal, Chief Operating Officer, and Kunal Malani, Chief Financial Officer at the company, who are with us to take some questions. Gentlemen, good morning. Good to have both of you here. Prashant this side. Pankaj, so third quarter largely in line, but concerns remain around demand, especially in the European market. And over the last few months, we've seen majority of the European OEMs reporting decline in production. Could you give us a sense there? I think we've started last few conversations around this, but this still remains top of mind. Is the situation at the margin improving at all? And I'm taking my cue for that question from at least stock markets in Europe, which are starting to recover after many, many years. You look at, the FTSE, the DAX, other markets, the Euro Stoxx 50 starting to come up a little bit. But tell us from a real ground-up level, especially in the auto side, what's happening?
A very good morning, and thank you for bringing us on the show. Motherson has a very diversified portfolio. So you see our performance in the light of a transitioning industry where this diversity has given a very resilient and stable performance. Europe automotive market, or for that matter, any other automotive market, may have some bumps up and down. But automotive demand continues to come back as people really want transportation all across their life, and it'll not come down in a long run. So we remain embedded with our customers. We continue to develop all kinds of vehicles, be it hybrids, ICE, or EVs. And as you see that most of our business portfolio, nearly 95% of it, is powertrain neutral. So in that sense, Samvardhana Motherson is positioned in a very strong way.
Gentlemen, before we talk about the Q3 numbers and the projections from here on, I just want to get this whole international uncertainty around tariffs, this whole conversation out of the way, because you have lots and lots of assets overseas, and obviously you're pretty big in exports. So first up, what is your total exposure to the US market? What is the quantum that you're exporting to it? Because I think you have various entities, I think some of them perhaps even in Mexico, some of the recent acquisitions. So just tell us, what is your net exposure and what are you preparing for in case those tariffs in the US, if they go up? Kunal, you want to take that?
Sure. Good morning, everyone. Look, we are around about 18% odd in the US in terms of our presence there. Mexico is around about 4% odd. Reality is we have a global local policy or a global local strategy. We manufacture where we are selling, so it is not that we are really importing, exporting too much of our parts. Having said so, there are obviously commodities which move in and out, and commodities in general is passed through in most parts of the world.
Kunal, sorry, Kunal, if I could interrupt just to understand, when you say 18%, are you saying 18% of your revenue comes from the US? And Mexico is and Mexico is 4%. So 4% of your revenue is Mexico.
That's right.
Sales to Mexico.
That is sales largely to Mexico. There will be some flows that will happen from Mexico to the US. But all of these are structured with a pass-through element in place, right? Or a large chunk of it is structured as a pass-through element because any customer-nominated parts as well as commodities will have a pass-through element largely for us. So any tariffs movement there really does not have an implication for us. Now, there are some parts which will be being bought by us and imported and exported, while the numbers will be small, and hence any impact there is going to be muted. Plus, the final impact is frankly going to be at the customer end and at the end consumer end, because it's not a challenge for us. It's a challenge for the industry as a whole. And hence, if there is anyone who will have to bear the brunt of it, it will finally end up being at the consumer end / the customer end, depending on what price point it does.
But it's about competition, Kunal, right? Sorry. I mean, just because of lack of time, I'm interrupting. But it's all about competitiveness. Now, if your products will be priced higher if tariffs go up, then what about potential loss of market share and competitiveness?
That's where I was coming to. So in the short term, the reality is it is not possible to change your supply chain overnight, right? At least for the product chains that we make, right? So for us, the implication will be a pass-through. And in the medium term, actually, it's probably going to be a slightly positive phenomena for us because we produce, as I said, locally. And having a presence in 45 countries, we can decide to, rejig our production planning in such a way that we can produce in, let's say, more favorable nations going ahead versus someone else who possibly does not have the kind of spread that we do. So in overall, it's neutral to positive the way we would see it on the tariff front.
Okay, so now with that out of the way, let's come back to the numbers and the expectations from here on. So given the talk of some recovery in the European markets, Mr. Mittal, if we could come back to you, how does FY26 look at an aggregate when you combine all the businesses put together? What's the sense that you have in terms of top line growth?
See, for us, we see opportunity in all kinds of situations like you mentioned. So we are an acquisitive company. And due to a lot of uncertainty in the market and markets going down or going up, there are lots of opportunities for us on the acquisition front, which our customers are talking to. So apart from organic growth, we are also looking at good acquisitive growth in times to come. And that's why you would have seen that we have also deleveraged ourselves. We are in a very strong position. Our balance sheet is strongest maybe in the last 10 years. So we position ourselves as a very good candidate, working together with our customers, being a very stable and a reliable partner with the entire industry. And on the other hand, we are also diversifying ourselves. As you would have seen that we have also started operations on the consumer electronics business. Our first facility is already ramping up. There are 2 other plants which are on track for SOP in the coming years. So we do see as a company, we continue on our path of creating a more diversified and a strong partner to the OEMs.
Can you, help us map that in terms of some sense of, revenue CAGR when you usually do these 5-year plans, right? And I think is it already time for the next 5-year target or not? Because the revenue at 36 billion target with 40% ROCE, I think that was the earlier target, is it? So what's the new roadmap, CAGR growth and margins next couple of years?
So still, we have to achieve 36 billion. So it's still some way to go, few more weeks. And then we will be coming with an announcement about our next 5-year target. So it is not, as you rightly mentioned, it's not just top line, but let's wait for a while before we come with the next target. So teams are very excited. They're all working. These are all bottoms up. Everybody in the world works together to set their next goal. Okay, fair enough.
Very quickly, on the 2 new acquisitions that you'd announced in the third quarter, Kunal, if I could come back to you. At Sumetic and Baldi Auto, one is a Japanese entity, the other I think is a Brazilian entity. When do revenues from these 2 start kicking in?
We are aiming to close both of them by end of this financial year. So while I think revenues won't be visible in Q4 as much, though the balance sheet may get assimilated, they should be visible in Q1. That's at least the current plan, subject to regulatory approvals.
Okay. And finally, Kunal, just leave us with an outlook on debt reduction. I mean, it's come down again in the third quarter as well. What is the, how will you end the year in terms of total capex? Because I think there's a slight revision, downward revision in the capex outlay as well for FY25 and debt. Where do you see the end of the fiscal year on both these counts?
Yeah, we've reduced the capex guidance to 4,500 crores from 5,000 plus minus 5. Primarily in order to realign our capex planning along with the SOPs that are being planned by the customers. So to the extent we can recalibrate, that's what we have done. Most of this reduction or delays, if I were to put it, is going to happen in the developed world. The emerging markets and the greenfields are largely in line with what the earlier expectations were. So there's no rollback on any of our growth capex going ahead. From a guidance on leverage, we are at 0.9x. We are aiming to close the year somewhere between, let's say, 0.7 to 0.8, subject to any new M&As. We do anticipate a fair amount of working capital reduction to happen, as we've always been saying. I think now we are seeing some of the geopolitical tensions getting potentially eased out. freight rates coming down, supply chain being a little bit more predictable, and hence the ability to then rejigger our working capital, which we hope to achieve. Part of it in this quarter, part may move into the ensuing quarters. So overall, we should still be on a deleveraging path somewhere around 0.7 to 0.8 or better.
Okay. All right, gentlemen, thank you very much for joining in, giving us a sense of the business and your overall plans going ahead. That's Motherson Sumi. But back to the markets, it's still painful. I mean, there was that attempted recovery, but it's not entirely played out because the mid-cap index is still down 1%, which means it's falling a little more than the large caps. And there you have the Nifty. So, Prashant, not much. I mean, 0.7%. Still lower. Big stocks like M&M, ICICI Bank, Hero Moto, all of them still down. And mid-caps are falling a little more.
Absolutely. I mean, if you want to do a poll, right, I mean, I think just to do a sentiment check and for institutional investors, etc., the mood is bearish. It's not just negative because prices have been down so far. I mean, if you ask leading questions about what next, where from here, at least over the next near term, in the next few weeks, I mean, generally the feedback is negative in that sense. So that's the picture. 22,760 is where the Nifty now finds itself at. Mitesh is back with us with just a quick view. 22,760. So basically around slightly under those lows last week and the January lows as well. Mitesh, what would you do?
So on the index, Prashant, no sign of a reversal is yet, but we are in that support zone, give and take 20-30 points. So not doing much, but hoping that if there's some sign of reversal, you might want to explore a long position. So for the timing, index is avoided. On the stock side, I have one buy and one sell. Paytm is showing some signs of a reversal, so buy here with a stop at about 730 for targets of 765. And InfoEdge and Naukri, I think, that's the stock which is slightly on the negative side. It's had a gap down today. So sell with a stop about 7,410 and look for targets of 7,100.
Okay, all right. Thanks very much, Mitesh, for that. Well, let's just, take a quick commercial break here. We're going to come back and we'll just put commodities under the spotlight as well, focus on what's happening there, what's top of mind. Manisha will help us with that in just a bit.
Welcome back. Let's move over and focus on the commodity markets now. We have Manisha back in the studios after a busy India energy week. She's back here with us. Manisha, so what are the headlines in your markets today?
Well, there's a bit of a profit taking across the market, but I do want to put focus on the precious metal prices right now because we've seen a very strong buying into this one, even as the prices are at all-time highs, the global markets are buying, and gold in some countries is actually trading in premium there. So we have seen an all-time high of $29.40 an ounce for gold prices. We're just about trading above 2,900 at this point in time. There is some profit taking from the highs that we have seen in this space, but let me tell you that the gold prices for last 7 weeks have seen constant gains. So they have given strong returns coming in there. Gold prices in 2024 gained up by 28%. And in this year until now, we are 11% on the higher side. So strong gains therein continuing into the markets in just a couple of months down this year right now. Well, the markets are concerned about various tariffs, and we've seen 3 rounds of that already happen. And then that would mean underlying inflation and a bit of a weakness in US dollar have been some supportive factors in case of gold prices. Apart from that, there has been a very strong shift from futures to paper gold. We've seen that happen in Singapore, much part of China, even US for that matter. And then apart from that, the US Fed monetary policy is something that the street will watch out for. It also is going to be about the US retail sales, where we've seen the numbers decline the most in the last 2 years. That has led to some safe haven buying coming in for gold as well. While there are prospects of peace deal between Russia and Ukraine, that's something that the street will watch out for. But apart from that, there also are conversations about further restrictions coming in from Iran. So the geopolitical concerns also are there in the market. a very interesting report from Capital Economics, and they, while in the near term, believe that $3,000 an ounce in gold is a possibility, but by the time this year ends, the expectation also is that you could be looking at $2,750, and that actually is the view coming in from various banks and brokerages there. I also want to quickly show you silver prices because we're trading at multi-month highs onto this one as well, highest since October 2024. The prices did gain 21% in 2024, and we have seen prices gain up by 14% in 2025 till time. So good going when it comes to silver as a precious metal also. I also want to show you on what we've done in sense of ranges in case of silver here. So 23 was between 19 to 27, and we've seen a higher highs come in for 2024, 22 to 35. So $7 of a range is what we've basically carried on. And this year as well, until now, we've traded a range of $3 when it comes to silver prices. Well, for the week, though, it's going to be the U.S. monetary policy meeting minutes that the street will take cues from.
All right. Thank you very much, Manisha, for that. So that's commodities. Well, in our special segment, Market Masters, Lata speaks with Victor Schwetz of Macquarie Capital on how long funds will pull out of EMs like India and continue to move assets into the US. It's an interesting conversation coming right up.